Hi, good morning, everybody. Welcome to today's webinar, Futures and Fundamentals, the State of Scrap. It's so great to have you with us. I'm just going to give people a few minutes to join, and then we'll get started with the content. Okay, I think we probably have everybody with us now, and if anybody joins later, we can catch them up in the Q&A. So as I said, good morning. Welcome to today's webinar, Futures and Fundamentals, the State of Scrap. I'd like to introduce you to my co-host, David Becker, who is Fast Markets Director of Risk Solutions. He'll be presenting with me. He is located in New York, and his role is to consult and provide our customers with an assessment of commodity price risk and describe ways to mitigate exposure. My name is Amy Hinton. I'm Fast Markets North American Recycled Metals Editor, and I run the team here looking after ferrous scrap, non-ferrous scrap, stainless scrap, and raw materials, including pig iron, DRI, and HBI. So for those of you that aren't familiar with Fast Markets, we are a price reporting agency that calculates and assesses over 6,000 commodity prices across multiple verticals. We have metals and mining, which is the vertical you'll be sitting in with us today to talk about scrap. We also have forestry products and agricultural products. We have over 550 employees across 15 global locations. We also provide event services, consulting services, and forecasting services with our research unit. I would like to talk to you a little bit more briefly about the PRA business and the process that enhances the reliability of our data, which underpins the assessments that we're able to provide. Obviously, today we're talking specifically about the North American ferrous scrap markets. So the industry submits transaction and contract prices to us. An experienced team of price reporters gathers that data, collates it, assesses it, and considers an appropriate price and rationale for any given commodity at any given assessment time. All of the prices are subject to three walls of defense. There's the initial price reporter, there's a peer reviewer, and then there's a final approver who will be an experienced senior member of staff or a section head. So we're robust, we're transaction-based, we're auditable, transparent, and controlled. And now that I've been speaking and I've introduced myself and my co-host, David, do you have any questions from a risk perspective on anything that I've just mentioned?
Well, thanks for the great introduction, Amy. Really appreciate it. I think a lot of people would want to know your view of what's going on in the scrap market and what do you see for the future of the scrap market?
Well, you flatter me, David, but I will take you up on that offer. So this is a great time to be asking that question, actually. So for those that are familiar with the monthly ferrous scrap trade, and I'll delve a little bit more into the fundamentals of that shortly, we've actually had an unprecedentedly early and swift settlement in July. I like to think that ordinarily, being the 9th of July, I'd be in the trenches still trying to get markets settled by the 10th, but we had a mill in the southeast came out with sideways offers on scrap on the 1st of July, and we settled our prices just 2 days later. I like to think that everybody was getting things teed up so that people could go away and celebrate the 4th of July. We had a similarly swift settlement in June, with the market breaking on the 5th and settling just 1 day later, also sideways. So with 2 consecutive sideways settlements, it does appear that the market is broadly in balance. We've seen import prices for finished steel spiking after Section 232 tariffs were revised to 50%, because material was still arriving onshore from foreign steel producers with 25% tariffs on finished steel. We are going into a traditional summer automotive shutdown season, which has impacts for prime scrap demand, so busheling, which will be a heavy topic of this webinar. Specifically, it's also retooling and outage season, so there could be, potential downtime across steel producers. But we are still looking at a pretty balanced market, and we do hear reports that some sellers are waiting for better prices and willing to sit on their tons. And if everybody started to liquidate their prime scrap positions, we might see a little bit of downward pressure. But in terms of prime demand moving forward, if you have a little look at HRC futures, they're certainly a bit lower, and there's some reports of challenged end-use demand. That said, US mills are melting, and we've seen capacity utilization rates hitting a high this year. They were just over 76% during the week ended the 28th of July. Really a lot hinges on stimulating consumer spending this end. There have been a lot of talks about the Fed rate cuts, but there are now reports that the likelihood of that are a little bit decreased. But obviously, if rates are cut, which stimulates consumer spending, we'd still be looking at maybe a 30 to 60-day lag on that demand trickling down into the scrap market. Just to wrap up, export markets are broadly stable. Turkey's still buying, the biggest customer of obsoletes from the US. But we last heard of an East Coast cargo to Turkey at 345 for heavy melting scrap 80/20, and that's stable with the slew of the last deals that we've heard. So that's a very whistle-stop nutshell description of what we see in the market at the moment. There'll be more time to delve into that on Q&A, but I'll hand back over to you, David, in case you've got some more questions.
I do, and it was really interesting to hear both the micro and the macro of what's going on. When you're talking about the different prices that you have, can you explain a little bit about the methodology that you use to create those prices?
Yeah, absolutely. I would love to do that. So just highlighting our suite of consumer buying prices for North America on this slide here. So we assess 16 markets across North America on a monthly basis, and that's commensurate with the way that mills in North America buy their material for the next month's production. Our methodology stipulates that we assess prices on or before the 10th of each month, and the balance of our 16 markets are assessed on a consumer buying basis. So when I say consumer buying, I'm talking about an all-in delivered to mill number for each grade that we assess. And that all-in price, the main distinction between a consumer buying price or a dealer selling price would be that the freight is included in that. So all of your freight logistics costs are included in the delivered number to any of the mills in North America within our footprints.
I appreciate that. And so you mentioned the consumer buying price is the target. Where does all the data that you're pricing and showing to the market come from?
Brilliant question, David. So I'm very lucky to head up a crack team of very experienced reporters. I've got 6 people, and 3 of which are heavily focused on the ferrous side of the market. And I would add myself to that number. So we canvass the market on both the buy and the sell side across the supply chain for data, asking for buying and selling prices during the settlement. And we collate a lot of data and use editorial judgment to come out with a finished assessment for the tradable level of any of those scrap prices during that month, because it's a monthly assessed price. Once we're satisfied that we can confirm the transaction levels on the buy and the sell side, and we can look at the weighting of the spot material being transacted, then we will publish an assessment that we feel is the appropriate tradable level for those scrap grades.
All right, and then earlier you said that you had some pricing where it came out in July on the 1st and the 2nd of the month, and then the month prior was also early. Why does it vary so much? Why are the prices coming out at different times during that month?
Well, that is a great question, David. And I have to stipulate there that we are an auxiliary function to the market. So we follow the market, we report the market, and we are very much guided by the negotiations in the market. So when we're confident and we've been, we're satisfied in the robustness of the data and we know that the markets have settled, then we publish our number. And obviously, we're at the behest of the mills. So if it's a particularly hot market and they want to come in quick and secure their tons to fend off any potential price increases with dealer holdouts, or vice versa, if it's a cooler month, demand isn't as good and they want to come out a bit later to wait out, let the market develop, maybe secure some lower prices, then we really follow what the consumers and the sellers are doing. And that's why it varies.
And you also mentioned, I think, that it needs to come out by the 10th of the month. What would occur if it came out after the 10th of the month?
Well, I'll caveat that by saying it does happen. And I think we'll talk a little bit more about that later. Aside of having my head handed to me on a plate, if the market rolls on for too long, we do have to be mindful of the fact that whilst mills are negotiating these numbers, they also need to keep production rolling. Sellers need to keep rail cars and trucks of scrap moving. We can't down tools for the 10 days that people are still trying to do business. So we have an observant period to really allow people to sign off, get their purchase orders out in a hopefully timely manner that allows them to deliver for the remainder of the month. We are the benchmark. So people utilize our numbers across the supply chain very heavily in products, in contracts, and people do use our numbers during the negotiation process. So that's why there's an emphasis on when we settle in particular over other PRAs.
Got it. And are there any times that you have like non-market adjustments where you have to make a change, and what causes those?
So that is a very good question. So a non-market adjustment is a process by which we will adjust the pricing of any given commodity outside of the traditional settlement period. Now, we reserve the right to do this because there are instances in which maybe mills will adjust base pricing for their consumer, or they will add premiums to our settled numbers, in which case it leads to the actual printed number for any of the grades to be out of kilter. Obviously, our MO at all times is accuracy, and Fastmarket's MO is to reflect the tradable level of any commodity in the market at any given time. So really, if we're made aware by the market that the numbers have become inaccurate, then we have a responsibility to investigate that. If we're made aware of a discrepancy, we go to the market with a pricing notice, and we'll follow up after 30 days, which gives us time to collate the data to maybe recalibrate the price. So there's a process, and it's one of the it's a double-edged sword. It's obviously a great privilege to be the market benchmark and to have such a high profile in the market, but that does come with its difficulties. So that's the broad function of a non-market adjustment.
Understood. And so, is there any particular reason why you just don't settle the market on trend or using the trend?
Yeah, so we are used all the way along the supply chain, all the way downstream to end users that utilize our numbers to calibrate their raw materials purchasing. We're used in contracts, and a number needs to be represented in contractual obligations. If we move the market on trend, we feel it's unreliable. Obviously, we understand that the broad way that the market functions is to stipulate that it's sideways or unchanged, that the market may be down $10 or up $10. But with the prevalence of side terms in certain markets and our own emphasis on reliability, it really is predicated on the price delivered to the consumer, emphasis on the price and not the trend. I will say we do have certain exceptions for Seattle and Portland, because of the way the market functions there. We have a consumer buying trend for those markets, but by and large, the consumer buying markets are all, the emphasis is on that number.
Understood. And so you had mentioned earlier that the price is settled once a month. Are there any indicators during the course of the month, weekly indicators potentially, that provide individuals an idea of where the trend is going or where the price might settle?
Yeah, absolutely. So here I'll turn my attention to shredded scrap very briefly. I'd stipulate that that's number two, auto shred, not low residual. So shredded scrap has the boon of being probably the most heavily traded. Maybe I think our assessment is 30 to 40% of the US domestic market because it can be used in flat rolled and long products. So it's very versatile. We have a monthly assessment of the shredder feed price for the Midwest, the Ohio Valley, and the Southeast. And obviously, that's the peddler price, the scale price that scrap sellers are paying for shredder feed that goes on to become number two shred. And that is a really good indicator of where the market may be going. And we price that every week on a Monday. Here I will just briefly put on my non-ferrous hat and say that we also have Zorba prices, which is a non-ferrous, the aluminium heavy component that comes out of shredded material. And we also price that on a weekly basis. So those two things can be indicators of where the shred market, for example, is going.
Perfect. All right. So this is a question that I sort of need a more detailed explanation. Can you tell me what TBD pricing is and how it works within the scrap market and how different people use it?
David, I would love to. We have an ongoing joke on the desk that TBD is every scrap seller's least favorite three letters. So TBD stands for to be determined, and it functions quite heavily as part of the monthly ferrous scrap trade. It's been sort of grandfathered in now because it allows dealers and buyers to agree to keep shipping material on a to be determined basis at such a time that Fast Markets, AMM, prints their monthly assessments. If I could refer back to the sort of monthly characteristic and the broad 10-day assessment and trading window, that's a pretty hefty proportion of the month. And if sellers were to stop shipping and consumers were to stop receiving material and everybody was to down tools for 10 or maybe more days of the month, it would be incredibly costly for everybody, and it allows people to continue operations to keep scrap flowing while negotiations are ongoing. I know we're focusing quite a lot on Chicago number one busheling here, which is obviously the assessment mechanism now for the CME busheling futures contract. Chicago is a 12 mil footprint. It was expanded in 2018 to comprise a significant number of mills. That's a really good example of a market that functions heavily on TBD. There are a lot of, obviously, spot trades that we're able to track, but it just allows those mills and the sellers in that large footprint and other footprints to continue business while they're negotiating and prices are being settled.
Got it. So to make sure that the supply chain continues to move on and logistics are not interrupted, there's contracts that people enter into that maybe are 12 months long, 6 months long, where they know they're getting the material, but they don't know what price they're getting. Is that correct?
So for this instance of TBD, I'm focusing mostly on the monthly negotiations. So people do buy month to month. So we'd be looking at TBD definitely more during the monthly assessment period, although obviously long-term contracts for large tonnage are also a significant function of the market.
All right. So in essence, though, without having a price and making sure that they're actually getting the delivery, they're exposed to some volatility in terms of the prices that they're going to receive. Is that correct?
I would say that is correct, David. And actually, that is a really nice segue for me to ask you some questions now. Now that we've gone through the fundamental part, maybe we can focus a little bit on that volatility element, which we've seen, we've seen a lot of that in the market of late with all the rafts of tariffs that have been rolled out since the inauguration. So, David, question for you. how do you characterize volatility? What is it, and how can you mitigate that volatility and the risk to your business?
Sure. Good question. Can you just change the slide for me, Amy? Okay, so I put up a price slide, which is a scatter plot, which is the monthly price changes of Chicago busheling number one as settled by fast markets. This is 120 data points, so that's 10 years worth of data points. And as you can see over the 10 years, the mean return, the mean change is approximately zero. What volatility is, what you want to describe volatility is different price percent changes from the mean. And as you can see from this scatter plot, there are plenty of prices that are largely changed from the mean, some up 40%, 30%, 20%, even down 20% and down 10%. And so the further those prices get from the mean change, the higher the volatility is. How do you mitigate those types of changes in price risk? You can use different derivative products to hedge your exposure.
Gotcha. Fantastic. Thank you, David. So since we're talking about some of those derivatives and those mechanisms, let's go to brass tacks. Can you explain what a futures contract is and how one would trade it?
Sure. If you could flip to the next slide, I put up this is a sort of a description of a cash settled futures contract. It is what is traded on the Chicago Mercantile Exchange for the Chicago number one. These contracts are financially settled as opposed to physically delivered. So as opposed to me buying a contract that is going to require that you deliver physical material to me. Instead, what would happen is you and I would agree on a particular price, and then at the end of a particular period, that monthly settlement, we would exchange cash. There is no physical movement. It is only cash movement. And what that does is it allows for broader participation in the market. So people not only who are looking to hedge their exposure, but people who might be looking to speculate on the direction will not have to worry about logistics or physical delivery. When you're trading a futures contract, there's always a buyer and a seller. And in the case of the Chicago number one, it is through the CME, which is a regulated futures exchange. In all instances, even though there's a buyer or seller, everybody that participates in trading that futures contract faces the exchange. The exchange actually makes good on all of the trades that are transacted on their exchange. And to be able to make sure that they have enough money to be able to make sure that everybody gets exactly what they're supposed to get, they require that everybody posts margin. It's a specific amount of money that's going to make sure that if there's a move in the marketplace, that you have enough money as a participant to ensure that you'll be able to pay for your losses. The exchange does not take losses for people who want to trade on the exchange. And each one of these cash settled futures contracts require some form of index to settle against. In this case, it's the Chicago number one busheling reported by fast markets.
Fascinating. Thank you, David. And I've always wondered, as I dip my toe into the futures market, about the form of these contracts. Are these standardized contracts that we're talking about here?
That is correct, Amy, and that's a really good question. A futures contract is standardized. This is from the Chicago Mercantile Exchange website, and it shows you some of the specifics. Each futures contract is 20 gross tons and is priced as US dollars and cents per gross ton. It gives you the specific trading hours that these markets are open for, as well as the different symbols that it has. It provides you how much each tick price is worth, as well as how the listed contracts are settled, which in this case is financially settled. It tells you the floating price, which is a fancy word for the index that is used on this. So it's the Chicago number one from fast markets. There's a rule book that tells you even further detail about how it is used, and then it tells you the termination date, well, the last date that anything can be produced on it. And so as a specification sheet, it's telling you the standard mechanisms that are used to be able to trade this contract.
Fascinating stuff. And then just to delve a little bit more into how these things are structured, can you talk about how these contracts are settled daily and on final settlement?
Yeah, it's an interesting concept because some of the times we get these questions, why did fast markets settle this contract today at this particular point? And the answer is, we did not. So there are two types of settlements. There's also a settlement for the prompt contract, the first contract, and then there are 24 contracts that are the forward curve that is used by the exchange. You can trade any of those. The daily settlement for those contracts are handled by the exchange. They use like a multi-tiered type of method to try to get the fair value of each contract on the trading day. That fair value or that tradable value is very important because it actually, in the end, generates any margin requirements or additional cash that somebody might have to either post or receive to be able to do that. Separate from that is the final settlement. That's where fast markets comes in. The price that you and your group come up to for this settlement is the end price that is used on the day of settlement, the last day that it will be able to really have a point that can be used. So on that last trading day, on that settlement day, the daily settlement and the final settlement will be used. But fast markets is only responsible for the actual final settlement, where the exchange is responsible for the daily settlements of all the futures contracts.
Wonderful. Thank you, David. Right. So you've won me over. I've decided to hedge, but I'm curious, are there any alternative derivatives to a futures contract that you can use to hedge?
Yeah, that happens a lot, especially this particular Chicago number one, as well as other types of metals and products. And so there is an over-the-counter market. An over-the-counter market is generally considered a bilateral agreement. You and I would be trading, but it wouldn't be you and I. Most of the time, it's a company and a financial institution or a trading company who offers derivatives that are very, very similar to the exchange derivatives, but have some minor nuances. Some of the nuances are they're customizable, so they're not standardized. While most might be a monthly settlement price, there's nothing in that could say that in a over-the-counter trade you wouldn't be able to do something that was quarterly or annually. So those are very prevalent. It also as I said, the agreements are bilateral. So as opposed to just having a broker or signing up directly with the exchange to be able to trade, you would have to work out an agreement with your counterpart about how you're going to do nearly everything. What happens if there's a default? One party can't pay. How is that going to work out? And they use an ISDA agreement. It's a particular legal agreement that specifies all of the information related to default and the index that is used. Most of the time, the index, especially in this particular space, is similar. The over-the-counter financial players would use a fast markets index to be able to settle their contract. One other difference is in many cases, but not all. In those agreements, there's no margin posting. So each side agrees that they will potentially allow the markets to move without collecting money for margin to make sure that the other party will pay, and then cash just exchanges at the end. So it is, it's each folks can decide which particular one is better for them, a standardized one, or in some cases, something that is over the counter.
Marvelous, thank you. And I'm sure people want to know, how can producers and consumers benefit from a futures contract?
So this particular chart that I'm showing you is just a payout profile. And it's something that both consumers and producers know in their head, but seeing a picture of it makes sense. A lot of this is theoretical. So theoretically, a buyer of scrap is going to have sort of a negative P&L consequences, profits and loss consequences when the price moves higher. And as you can see from the chart on the left, as the price moves higher, the P&L starts on the y-axis, moves lower. And the reverse is true, is price. Nobody who's a buyer, as they're waiting for TBD pricing, says, ooh, the price went down, that's bad for us. They're very happy about it. And then as the price goes down, you receive sort of a benefit. And it's exactly the opposite for a producer. As the price moves up, especially during that TBD period, they're gaining some value. And as the price goes down, they're losing value. And that's all because the price is not fixed at a particular level. They don't know what it is. It's going to be TBD. And so both can actually benefit. And if you switch to the next chart, I will give you an idea. This chart actually just shows what happens when you go about hedging. So from the consumer side, as prices go up, as I mentioned, they're going to experience some theoretical loss during that TBD period. But if they buy a futures contract to hedge their exposure, their financial benefit will go in lockstep for the most part with their physical benefit. Unfortunately, when the price starts to move down, if you're a consumer, you're although you have a theoretical benefit, you are going to have that same theoretical loss. So what you're doing is saying, I am happy with the price today, and I want to lock that in. It's the same thing for the producer. From the producer standpoint, they can look at the prices now, and if they want to go and sell and lock in those prices, they can benefit as prices go down from the financial perspective, from the futures contract, but they would theoretically lose some money if prices go down on their physical side.
Gotcha. Thank you so much, David. And I'm sure I'm not alone in this. It's much easier to understand these mechanisms when you've got a practical example to pin them to. So that said, could you talk us through an example of hedging?
Sure, I will read this. I'm sure everybody can read it as well too, but let's just say company scrap team A is holding some inventory. They got it at a really good level, and they eventually decide that they're going to sell their scrap to building company for 3 months from now. We'll just say October from now. And they're going to use the Chicago #1 busheling to determine their price. So they don't know where it's going to be in October. Actually, the market doesn't know where it's going to be in October. And when we get into the October period, it's going to be TBD. So what can they do about it? What can they do to make sure that the price doesn't fall and they have some theoretical losses? And that would be the concern of scrap team. And so to achieve their goals, what they could do, I'm just giving one futures contract that they sell at the prevailing market rate. So what they're able to sell in as a futures contract on the exchange. 20 gross tons, as I mentioned before. We'll just say they locked in a price of $460 per gross ton. So now they're locked in. They don't really have to worry about the price falling anymore. And if the price rises, well, their physical benefit, the TBD, will offset any financial losses that they have. In this example, let's just say that at the end of October, Amy and company say, oh, 450 is the settlement price for the scrap number one in October. What the hedger would receive, scrap team, is the difference between 460 and 450, $10 per gross ton, which comes out to $200, which would likely be offset by the theoretical loss that they would have in their physical market. And that's how, and that's an example of how to go about hedging and what it would look like.
Lovely. Thank you, David. It's always nice to have a practical example. Then moving over to something that's particularly important in the current climate, the costs. What are the costs associated with hedging and risk management?
Yeah, so this is really going through the process of hedging and risk management is an investment decision. It comes down to what you really want from your business, what you want from your budget. The first thing that happens is I'll just go through the benefits. You're removing price volatility. So you're not going to wait for the TBD price. You're actually going to say, we're expecting this. We're going to use this price. Today is the price that we want to use. It increases your ability to budget and forecast correctly, because now you actually have a number that you can hang your hat on, and it reduces the volatility of your profits. So that first example that we had in terms of volatility, sure, it could be all over the place. Instead, if you're thinking, I don't want to see anything more than like a 5% move either way, even zero would be better. Well, you have that capability. But with that capability of reducing your volatility, as well as having better forecasting, comes some costs that you need to set up and be aware of. There are execution costs. So there are transaction fees when you trade futures. There's a bid offer spread. Usually the bid price and the offer price are not the same price. Somebody will sell at slightly different price than somebody will buy. That is that spread, as well as you have to post some margin. You have to take cash out of your operating budget and say, we're going to post this so we can be able to do it. You have to have certain compliances in accounting. Without going into detail, there's something called hedge accounting, which makes it so that if you're going to hedge, especially in the United States, you have to show a like for like type of thing. You can't say, I hedged my Chicago #1 busheling scrap with the S&P 500, and now I want that to be the way I handle hedging. Your accountants will require that you have like for like Chicago #1 busheling that settles versus the fast market data is the same as the futures contract, so it works out well. There are operational costs where you have people internally who are managing the hedging program and issuing particular invoices or confirmations. And lastly, somebody's got to monitor or mind the shop. It's not one of those things that you set it and forget it. You have to be able to look at it and monitor it and report on it. And so all of those things are costs that you have to put into being able to remove the volatility from your underlying budget and profits.
Understood. Well, what should one do? What steps should one take to determine if you want to hedge, other obviously than get in touch with you for some practical advice?
Well, thank you very much, Amy. I think without a doubt, the first thing is understanding exactly the types of risks that you have. Fast Markets has some tools that we can provide you that will allow you to determine what kind of risks that you actually have. Once you figure out those risks, right, and you make the decision that you're not specifically happy with those risks, you don't want to see the market pumping up and down all the time. The next step is figuring out the best practice for mitigating those risks, using a futures contract, which is prevalent, using an over-the-counter type of mechanism, which is also a fair way to go about doing it, and then making sure that you're willing to put in as a last step, the costs. You're willing to set up your program to ensure the profitability that you want. And so it's a three sort of step process to be able to do it, starting with measurement, moving on to management, and then all of the accepting the investment decision in that process.
Marvelous. Thank you so much, David. You've almost won me over. I might start hedging, busheling myself if I ever leave fast markets. No, obviously, I am joking. Just to turn us over quickly to a disclaimer, which gives you a little bit of information on the information contained within this presentation. And just, I'm not going to bore you all to tears by running through it, but just to say that this information has been provided for reference purposes only. David, thank you so much. I always learn a lot when I sit down with you. It's nice to get to do it in a formalized setting. I also want to say thank you to everybody that's participated and joined us this morning. And I'm very happy that we've got some time for Q&A. We've already got some questions that have come in locked and loaded. So I'll happily, people are more than welcome to take themselves off mute and ask questions verbally, but we do have some in the chat. David, obviously, we've got one for you straight away. Can you enter and exit the CME scrap futures contract, or do you have to wait for settlement once you enter? It's an excellent question.
That is a really good question. And all of our discussions have been about the settlement, but the way these futures contracts work are very similar to the way almost all futures contracts work, as well as different stocks. You can enter and exit at any particular time on the same day, within a very few minutes, seconds, whatever you feel like doing. A lot of people do wait till the actual settlement for their hedging purposes, but there's no restrictions on getting in and out. You definitely do not have to wait until the end. And Amy, I see one in the ask for you right off the bat. So what is happening to the Midwest indices now that the CME busheling futures contract has moved to the Chicago #1 for the consumer assessment?
That is a great question. Thank you to you, David, for delivering it, and to whoever asked. So we had 3 indices assessments for heavy melt, shred, and busheling. These were calculated assessments for collated tradable values within Detroit and Chicago, so a wider footprint there. We transitioned the settlement of the CME futures contract to the consumer assessment at the end of 2024. We retired the heavy melt and the shred at the end of March. We're still calculating the indices for #1 busheling up to the end of this year, at which point the CME will be discontinuing the outstanding contract, and we will no longer be calculating the indices for Detroit and Chicago. It's worth mentioning the difference in methodology there, whereby the indices included assessments, sort of transactions for springboard material, which is material that's coming into the Midwest markets from further away. So as a result, that calculated price was often a little bit higher than the Chicago consumer assessment itself. But to use the vernacular, the CME is no longer going to be settling against the #1 busheling index, and we won't be calculating that number. So it will be going the way of the dodo at the end of December. But people are more than welcome to ask me more questions about that. We would obviously advise people to look at the assessments for Detroit and Chicago, particularly as it pertains to futures contracts. David, I've got another question for you. Hello, first and foremost, the user says, I'm a trader of scrap. I have a hard time hedging my exposure. LME liquidity is low and I can't find an alternative way. Can you please suggest some solutions to this?
All right, so we've gone through some of the different ways you can go about doing it. Obviously, the first thing I would say is the scrap price, and it depends where your scrap is located. But assuming that the scrap is located in the U.S. or you have scrap that is highly correlated to the scrap price of the fast markets Chicago #1, using the Chicago Mercantile Exchange would be the best bet in terms of being able to limit your exposure. Of course, you could also use an over-the-counter mechanism to be able to do that as well. So those are two different solutions other than the London Metal Exchange to be able to hedge your Chicago #1 scrap. And
Brilliant. Oh,
I mean, I see one for you as well too. I'm not, this one looks like it says, what is Amy's confidence in the Hamilton market pricing? Shred pricing is higher than busheling.
so Hamilton is one of our Canadian markets that we assess every month. So typically the Canadian prices settle after the US prices. So I would have to check verbatim on those levels, but it's not unusual. Obviously, I have high confidence in the ability of our team to price those markets accurately. It is not unusual for shred and busheling prices to invert from time to time. They can be used interchangeably. They've got slightly different melt yields and pricing levels, and those markets can invert depending on whether one is prioritizing furnace efficiency or whether one is prioritizing cost. There are multiple things that go into this. So high confidence level, it's not unusual for those to invert, but what I will say is I'd be happy to look into that. If the question asker wants to contact me at amy.hinton@fastmarkets.com, we can have a more in-depth conversation about that market in particular. I'll caveat that by saying we always want to hear feedback from the market. We're market driven. We want to hear from you about questions such as that. So if anybody else that's on the call has similar concerns or questions about any of our scrap pricing suite, then please do contact me, whether it's within this webinar or outside of it. David, I think we've got one for you. How active is the over-the-counter market? And is it cleared bilaterally as well or centrally?
All right, so the over-the-counter market is active. There are multiple financial institutions that provide this type of mechanism. So there's no lack of players within the over-the-counter market. It is cleared completely bilaterally. It's not cleared centrally like the exchange. Now, the exchange does offer the opportunity to trade with somebody and clear on the exchange, so you can do a privately negotiated trade. But when it comes to over-the-counter markets, those are completely trade bilaterally. Let me see what else that we have. Just looking for other questions.
I've got one here that I can answer that's a nice and easy fix. So a different type of question, the asker says, where do you have scrap grade specifications on your website? So if you go to fastmarkets.com, you will see a segment at the top labeled methodology. All of our methodologies across all verticals and across all prices are publicly available on the website, and you can access a PDF document which will give you all of the prices, including the terms, the settlement dates, the specifications of the material. So yeah, head to fastmarkets.com, look for the methodology tab, and then you can search under the headers whether you're looking for ferrous, non-ferrous. I would say that some of the sections are headed with Metal Bulletin, which is our legacy publication in Europe. Obviously, the AMM pricing is the legacy name for Fast Markets in North America. But again, if you have any difficulty, please do reach out to me, and I'd be happy to provide those methodologies to you.
I see one that says, if I want to get set up for trading / hedging, who should I reach out to? The group that you want to really reach out to is the Chicago Mercantile Exchange. They will help you with some of the information that you need, as well as point you to a broker who might be able to facilitate your trading and hedging. You can also come directly to one of the people at Fast Markets. You can come directly to me. We'll have a follow-up on this, but then I will point you to the correct person at the exchange for you to start that process.
Brilliant. Thank you, David. And here's another one. When I bid on ETP tin plate, for example, how can I get the benefits of your monthly prices? I buy from the USA. Is that something you're able to answer, David? That sounds like it's sort of one, half of you and half of me.
Yeah, I would have to get back to the person on that question. I don't have an answer off the top of my head.
Perfect. Well, likewise, I think we've got another question about the mechanism. What will make the contract trade more successful than the prior AMM contract? All that's changed is the index reference. What will increase participation? So I assume this is talking about the switch over from the Midwest Busheling Index to the Chicago Consumer Assessment. So one is an index. We're retiring the index. The futures are now settled against the consumer assessment for Chicago. As I mentioned earlier on, when I was talking about the physical prices, we're very market driven and we take feedback very seriously. And the feedback surrounding the futures contract and its tradability was showing a preference for a different mechanism. And after sort of a hefty amount of investigation and research, it was decided that it would be better on all sides for that futures contract to be settled against a consumer assessment that is backed by a lot of physical market activity and contract utilization. And that number is the Chicago busheling assessment. So it was our understanding that participants that wanted to actively trade and provide liquidity for that contract wanted to use that, what they considered to be a more robust and contractually backed mechanism. In terms of what can increase participation, I would urge you to reach out to the CME, who will be able to give you a better indication of what they want to do on that side to increase visibility of that contract and increase liquidity. So that would be my advice there. David, I don't know if you have anything to add on your side in terms of trader confidence when it comes to pricing mechanisms.
I'm not going to add anything more to it, but in terms of liquidity, education is the thing that helps people the most. I would say that this type of webinar, as well as coming to the different conferences that Fast Markets has, we have our circular steel, that those type of educational and networking type of events leads to greater participation in the markets. Having financial institutions is a gigantic help within there, because what those over-the-counter agreements do is provide opportunities for those financial institutions to lay some of their risk off on the exchange. And so there is a circular way of the way that risk is laid off that helps liquidity. And eventually what starts to occur is speculators enter that market, creating even further liquidity. And that's how I see that specific Chicago number doing better than the index that we saw prior. I see one that's a sort of a view question on tariffs, Amy, that I don't know if you'd see it, but what does Fast Markets think will be the longer term impact of a 50% tariff on imported steel? Its impacts thinking on shorter term versus longer term ferrous scrap buying strategies. Any view on that?
That's a great question. I have views on that, David, and thank you to whoever asked that question. So as I mentioned earlier on, we've seen a spike in import prices after the revision of the 232 tariff to 50%. Previous to that, we were hearing, and I think the word I used was flotillas of material that was still arriving in Houston for hot rolled when the tariff was only 25%. So we are seeing that they're having an impact and making imports less competitive. But with hot rolled in the US broadly at $900 a short ton, there is still a sense in some quarters that, imports could still compete. The next layer of this, I think, is something, again, I talked on about earlier, with stimulating consumer spending. So the tariffs are starting to do what they were designed to do. They do what they say on the tin, as it were. But I think really the consideration here is getting domestic consumer spending stimulated to further increase those hot rolled prices to really get this market to take off, if you like. So we're definitely seeing that the impact is happening, but I think there needs to be some stimulation onshore in terms of domestic consumption, really to get those tariffs and to get those prices up and to stimulate demand for scrap. That's a very simplistic view, but I think really at the moment we're sort of only part of the way towards where we need to get. We're also getting quite a lot of reports that even though capacity utilization is peaking, it's at a high at the moment, and I think 80% and above is considered to be like a good full running rate. We're still hearing that some capacity is a little bit slack with some of the increases in capacity that we've seen at certain mills. So I think that's also a consideration that is dampening the market. If that hasn't fully enough answered the question, I'd urge whoever asked to get in touch with me for a longer discussion that we can take outside the webinar, because this is something that we keep a very close eye on, and obviously views develop daily based on how the policy is rolled out.
Excellent. I see another one. This one's for me, so I'll read it. How are speculators capable of adding liquidity of trading a product value on a single print index assessment without getting run over by not having a foot in the physical market, which is a really good question. And it has happened before in different types of markets. The key in this particular instance is to use the indices that Amy had mentioned earlier that are weekly or even daily, by looking at the prices that are showing the direction for it. And so in essence, what you're trying to do is use those inter-month data points to be able to determine the trend relative to the fixed price that you might have traded, either buying or selling, to a client. And so to me, that's the best way to go through that particular process, to be able to, as a financial speculator, become more involved with it, using the intra-month indices that are available from fast markets.
That is a really interesting question. One thing I would add actually onto that is that if people want a better view of the physical market and they're looking to marry up the physical with any sort of speculative position they might want to take, I would urge people to attend our event in Houston every January. We have the whole supply chain shows out in force, and it's a really good way to learn and to network and to maybe broaden your base in that market and get more comfortable with the physical versus the futures. So just a little plug there. Anyone can ask me for information. I'll be there. David was there last year. I'm hoping he'll join us again. So if you want to broaden your knowledge and your horizons, please come and break bread with us in Houston in January. And I don't think I see any more questions, David. I don't know if there's anything else you want to say before we wrap what's been a very enjoyable hour up.
Oh, I thought it was fantastic, Amy, and you did an amazing job giving a view of the markets, as well as, moderating and going through this entire process.
Well, likewise, David, as I said earlier, I always learn a lot when I get to sit down with you. It's been a real pleasure. I want to say thank you again to everybody that's joined us for this discussion. And I would say that David and I are more than happy to keep the conversation going outside of the remit of the webinar. So I think without further ado, I'm going to wrap up today's session. Thank you so much, everybody. Thank you again to David, and we really hope that you'll be in touch with us. Bye-bye.